So I was at a friend's place recently, and since we are in a bull market and against all my wishes, we got down to talk about investing. As I'd expected, most of the discussion was around what the markets have done in recent times and where they are likely to go after the new government gets down to work. I tried to move the conversation towards long-term investing, but was pulled back again and again by things that worry people in the short term. And that led me to think about creating this episode of the Inner Game podcast where I talk about something a bit unconventional but very important. The few things you should not care about as an investor. So let's dive right in. The first thing you should not care about as an investor is how much other people are earning from their stocks and their other investments. Now, we cannot get away from the fact that we live in an interconnected world, and the instant updates in social media tell us how much richer other people are getting from their stocks. In fact, it's all too easy to get caught up in the success stories of others. And we see our friends, our colleagues, and especially social media influencers boasting about their stock portfolios and their newfound wealth. This can, of course, create a sense of urgency and even envy. But here's a secret: their success has nothing to do with your journey. Imagine you are in a race, but each runner is on a different track with different hurdles and different finish lines. When you compare your progress to theirs, it is not just unfair, but also meaningless. Each investor's situation is unique. They have different risk tolerance, different financial goals, and different investment strategies. But when you focus on others, it distracts you from your own path and it can lead you to poor decision making, which is driven by emotions rather than logic. Not to forget that most of social media is clickbait, where people, especially those with large followings, often lie just to grab your attention. And so you also need to take that into account. Remember, investing is a very personal journey. Your goal is not to beat others, but to achieve your financial objectives and financial freedom. So keep your eyes on your own track and let the successes of others be a source of inspiration and not comparison. The second thing you should not care about as an investor is your recent performance in the stock market. Now, this is one thing we all culprit of, which is checking our portfolios on a daily basis and feeling happy or sad seeing our recent performances, especially when these are not what we hoped for. Maybe the market's been turbulent recently, or you made a few bad calls, or the market is rising and you did not invest much. Now, I know it is easy to get disheartened, but the thing is that short term performance is not a reliable indicator of long term success in life or investing. Just consider the story of a seasoned investor who experiences multiple market crashes and economic downturns over his lifetime. Despite these setbacks, they remained focused on their long term strategy. And over time, their portfolio grew significantly, far outpacing the market averages. It's very important to remember that investing is a marathon and not a sprint. Short term fluctuations are a normal part of the journey. What matters is your long term investment philosophy and how well you stick to it. So instead of obsessing over recent performance, ask yourself if your investment aligns with your goals and if you're following your plan. Stay disciplined, stay patient, and remember, time in the market beats timing the market. The third thing you should not care about being an investor is how much you paid for an investment. This, I think, is one of the biggest traps investors fall into, which is anchoring to the price they paid for a stock. This psychological bias can cloud our judgment and lead to poor decisions. Let me share an example to illustrate this. Imagine you bought a stock at 100 rupees per share. The stock price falls to 80. You buy more to average down your cost. The stock falls further and you buy more. Now it goes down to 40 and then 20, and you buy more and more of the same stock. It's then that you realize that the stock was falling because the business was turning bad. Or maybe you had already realized that earlier, but were hoping that things would improve over time. But after owning so many shares in their falling stock, you now own a large part of the holding in a declining business in your portfolio. All because you were anchored to your first buying price of rupees 100 and the stock was getting cheaper and cheaper and cheaper. This is known as anchoring bias, an explanation of which I will link in the notes. Always remember that the price that you pay for a stock is irrelevant to your current decision making about the same stock. What matters is the business's future potential. If you realize the stock was a poor investment because you made a mistake in buying a bad business, holding on to it just because of the higher price you paid is not rational. Good investors focus on the present and the future, not on the past. And so you must evaluate your investments based on the underlying quality and long term prospects of the business, not the price you paid for it. I believe this shift in mindset can help you make more objective and profitable investment decisions. Anyways, the fourth thing you should not care about as an investor is your educational qualification or your IQ levels. Now, there's a common misconception that you need to be a financial genius or financially very smart or have a prestigious degree to be a successful investor. This could not be further from truth. In fact, emotional intelligence or EQ often plays a more crucial role than IQ in investing. Think about the best investors in the world, and you will realize that while they were undoubtedly intelligent, their success is attributed more to their temperament than their intellect. They are known for their patience, their discipline, their ability to stay calm under pressure, which are all hallmarks of high emotional intelligence. Your ability to manage emotions, your ability to stay disciplined and make rational decisions often outweighs technical knowledge. You might be highly successful in your career, have a stellar educational background, but if you cannot control your emotions in the market, it can lead to poor investment decision making. So focus on building your emotional resilience, learn to manage fear and greed and envy, stay patient, and make decisions based on data and your investment philosophy, not emotions. I believe investing success is within reach for anyone willing to cultivate these traits. Finally, the fifth thing you should not care about as an investor is beating the market and other investors, both in the short term and the long term. I see many investors getting caught up in this idea of beating the market or outperforming other investors. This competitive mindset can be detrimental. The truth is, consistently beating the market is extremely difficult and often relies on luck as much as skill. Instead of trying to beat the market, focus on meeting your personal financial goals and surviving economic and market downturns over the next few years. Create a diversified portfolio that aligns with your risk tolerance, your investment horizon. Stay consistent with your investment philosophy and avoid the temptation to chase high returns or follow the latest trends. Peter Bernstein wrote in his brilliant book Against the Gods that survival is the only route to riches in the stock market. As an investor, you should try to maximize returns only if losses would not threaten your survival. Remember that the market is a complex system which is influenced by countless factors. Trying to outsmart it can be a futile and exhausting task. But when you focus on your own goals and maintain a steady, disciplined approach, you're more likely to achieve sustainable success as an investor. Before I end, let me tell you that successful investing is not about keeping up with others. It's not about obsessing over the purchase prices. It's not about stressing about recent performance. It's not about relying solely on your academic qualifications and intelligence levels. It's not about constantly trying to beat the market. It's all about focusing on your unique goals, maintaining emotional discipline, and staying the course. By letting go of these things that you should not be worried about as an investor, you free yourself from unnecessary stress and distractions. You can then focus on what truly matters, which is building a solid, long term investment philosophy that aligns with your personal financial goals. Thank you for joining me today. If you found this video helpful, please don't forget to like, subscribe, and share it with others who might benefit from this perspective. Until next time, invest wisely and stay mindful. Thank you so much for your time.